Hello, everyone. It's Paul Feldman, Insurance Newsnet, and I am graced to be here with Tom McInerney. It is so good to be with you here. Tom is the CEO of Genworth Financial. And Tom, just as a question, how did you get into this industry?
So I started in insurance in 1978 out of college, and I spent more than 20 years with Aetna and all of its businesses, all lines of business around the world. And I was running the financial division of Aetna, and that got sold to ING, big Dutch financial service company. I've spent 11 or 12 years there, and then I ultimately came to Genworth 12 years ago.
So, Genworth is a leader in long-term care insurance, and it's been an interesting marketplace. Tell us a little bit about the challenges that you faced and where you see it going forward.
So I would say that I think it's very unfortunate that when the business started 40 years ago, the regulators and the insurance companies and probably the policyholders all believed that the way to run the business was to start with original pricing assumptions and try not to adjust premiums until it became very obvious that there were issues. And so I think as a result of that, the history and the legacy, which has not been good, as everyone knows, is that because the product was approached as a generally a level premium, although there were always the right to raise premiums as needed, that took way too long to happen. And so, my view going forward is the private individual LTC business could be a strong business as long as you start with conservative assumptions for things like interest rates, lapses, and the incidence and the severity of claims, but then look at the original pricing assumptions and reality every year. And to the extent that they differ, make appropriate adjustments in the premium levels, just like on most other lines of insurance. That wasn't done. And I think going forward in our new business, we are in the process of filing a new long-term care insurance product under the CareScout brand. And the essence of that will be we're starting with conservative assumptions, but we'll review those annually. And to the extent that the assumptions prove to not reflect reality over the next 40 years, we'll make assumptions along the way. And if we need to change, we will do that.
Have you seen like just things change into that marketplace as far as I mean, because actuaries are not always accurate, and we've seen that all over the place. Have you seen a difference in like humanity and things like that?
Well, if you look at what were the historical problems of and the pricing, the assumptions, is when we all started 40 years ago, interest rates were a lot higher than what they've been, although in the last 6 to 8 months, interest rates have come up significantly. So there is an issue with interest rates. I think today products are being sold at with assumptions that are more consistent with where interest rates are today. The other thing that we and most insurers got wrong, or is we didn't know what the lapse assumptions would be when we all started. And so we looked at what were lapse experiences on other similar products. And the one that comes closest to long-term care is long-term disability. And the annual lapse rates for long-term disability over the long run have been in the 5 or 6% per annum range. So that's what we used. It turned out for most insurers, the actual lapse rate was less than 1%. So again, that was a big driver of the changes. So I think today,
That's interesting.
most insurers that are writing, and there are less than 10 that are still writing business, including us going forward under the CareScout brand. But today we've got interest rates more aligned with where the market is today, and we are assuming the annual lapse rate will be less than 1%. And then for us, we've paid 370,000 claims over the last 40 years,
Wow.
about $30 billion worth of claims. And so versus when we started and we had to have a projection without a lot of claims data, we now have a very significant set of claim data on incidents and severity. And so we think pricing today reflects what the historical experience has been. So I believe going forward that in our case, our new CareScout Insurance line of business, we have products that are priced based on where interest rates, lapse rates, and the long-term trend in claims have been. And I think they will be much better going forward. However, since no one can predict what interest rates will be over the next 30 or 40 years, or if claims will be different, if the 30 billion we've paid so far will be different in the future. I mean, I think they'll be similar, but we don't know. And so what we've agreed with the regulators, and I think regulators have accepted, is no one can really predict the future out 30 or 40 years. So we need
Yeah,
to
no kidding.
review the original pricing assumptions in reality. And we see when and if we see those being different, we make changes immediately. So the amount of the increase, if we need them, and hopefully we won't on a new product, will be very low single digits versus what has been the historical experience of waiting very long to make changes in assumptions and then needing very significant premium increases.
So one of the things that you guys do, and you do it very well, is you do studies every year. Tell me from the studies that you've conducted over the last few years, how things have changed in the marketplace.
So we've been doing the annual cost of care study for 20 years. I do think that, and what we do there is we survey home care providers, assisted living communities, and nursing homes for their rates in the various zip codes and MSAs around the country. And I think we've been very accurate in looking at what the pace of pricing has been. I think in the long term, if you go back a long period of time, inflation rates were in the 2 to 5% range, depending on the region of the country and whether it was a home care or facility care. I think in the last few years, what's changed, and a lot of this is driven by the increase in minimum wages, because as the hourly rates have gone up due to significant rises in some of the larger states, we have seen cost of care rise based on that higher inflation rate, driven by raising minimum wage in many states, and also the supply demand, with demand for care as the baby boomers age going up significantly, whereas the supply is not really keeping pace with the demand.
Yeah, I mean, and Tom, I have to give you credit for serving a market that is very underserved. When you have 10 carriers doing this, and you guys are, paid out $30 billion in claims, I mean, that's really helping society. And I'm not pandering to you when I say this, but I do think that's a good thing. Tell us a little bit about this. And is it Care Scout?
Care Scout.
Okay, I'm not familiar with this. I don't know that my readers are, and I'd love to hear more about that.
So Genworth Financial acquired Care Scout in 2008. And historically, Care Scout has been a very important subsidiary for us in the long-term care industry. Primarily what it has done up until now is run the cost of care survey process, as well as do all the assessments when our policyholders file a claim. Care Scout has done all of the assessments of the claim, what the care needs are, and then they approve the claim, and then the claims get paid. Going forward, in addition to continuing with the cost of care survey, continuing doing the assessments, there's two other new businesses that Care Scout is launching. One is already in place, and that's called Care Scout Services. And in Care Scout service, one thing that had never been done in the long-term care space is have someone put a quality care network in place where we also negotiated the fees that providers charge. Whereas in medical insurance, health insurance, PPOs and HMOs have been around for 40 years. Well, that never had occurred in the long-term care space. So Care Scout Services is one of the Care Scout new businesses. And we've created a Care Scout quality network. And we now have over 80% of the zip codes in the US. We have one or more quality care providers that have been screened by Care Scout for 20 criteria of quality. And then in addition, we've negotiated discounts. So versus their normal, what they normally charge, they're providing Genworth and Care Scout customers a 20% discount versus their normal rate. And it's also generally 90% of that discounted rate is below the median cost of care in those zip codes. So so we provide to our policyholders. Ultimately, we're going to expand the offering to other LTC insurance policyholders as well as consumers in general. So again, you would come to us whether you're a policyholder or a consumer without any insurance, and we would use Care Scout to assess the claim, come up with a care plan, and then we'd recommend that you Care Scout quality network provider to you, and if you chose that provider, then you would be able to receive preferred rates that are generally about 20% below what that same provider would charge in general. So that's one of the new businesses of Care Scout, in addition to the assessment and the cost of care survey. And then we're launching our first new long-term care insurance product next year with another subsidiary of Care Scout called Care Scout Insurance, which again, it will have better, more conservative assumptions that reflect the current reality, but also an understanding with regulators and with our policyholders going forward that to the extent that those price for assumptions differ from what reality is, will change the premiums to reflect that.
So, there are only 10 standalone carriers that are offering long-term care. It seems like a lot of the market has gone towards life insurance as a rider or an annuity as a rider. Why is a singular policy better?
Well, I don't know that one is better or not. So
Okay,
what we'll
fair.
call a standalone long-term care insurance, like this new policy I just described for Care Scout Insurance, because there's no life insurance associated with it, the premiums go all towards paying the LTC claims in the future.
Hmm.
So therefore, there's generally more coverage on those policies for long-term care than there is in a hybrid. On the hybrids, but the complaint about traditional long-term care historically has been, well, if I never use the policy, then I pay these premiums and I've gotten no value. So hybrids were introduced many years ago for that need, that if you have an LTC care need, the policy covers that. But if you don't have care needs, ultimately there's an annuity or a life insurance benefit that ultimately is there if you don't claim. The first product is a traditional long-term care insurance product, but we will be going forward with a whole set of new hybrid policies that will combine hybrid features, life annuity, including variable annuities with LTC benefits.
Interesting. So what's your distribution strategy with that?
Yeah, we will rely on the current distribution that's available, which is the traditional, which is broker general agents, independent agents, financial planners, financial advisors. We also will offer these new products to employers. So in the work site,
Hmm.
so there you're typically using brokers who sell group benefits to employers, and then the employees then will enroll in that. So we'll offer both intermediary distribution and employer distribution currently. And then going forward, we're also looking to build the CareScout brand and ultimately go direct to consumers without an intermediary agent. But that's
Which is
probably several years down the road.
okay. And what would you tell somebody who isn't selling long-term care insurance right now?
What would I
I mean,
tell?
yeah, what would you tell them, like
You
why
mean
should you be looking at
an
this?
agent? An
Yeah, like
agent?
an agent, a distributor, like I mean, I see long-term care as one of the most important things to anyone's financial plan, and it seems to be missing.
I think that's right. I think there are many reasons for that. Among that is, I think in general, American consumers believe that Medicare covers long-term care, which it doesn't. So we and I think the Medicare planners need to be better at educating the public on that. The second is it is expensive, but that's because the care is expensive. So I would say to most individual Americans, as well as distributors who sell insurance, which are risk management products to consumers, that and speaking particularly to the 70 million baby boomers who next year in 2025 will be 61 to 79 years old, that half of them at some point in their life will need long-term care and a significant need for long-term care. And if you don't insure against that with private insurance, then you're going to have to come up with those the amount to cover that care out of your own savings. And the average claim that we've seen over time has been about 250,000. But
Wow.
some claims, particularly Alzheimer's or dementia claims, can be well over $1 million, depending on how
Wow.
long the claim
Holy
lasts.
smokes.
So I would say not having long-term care insurance or not having savings dedicated to long-term care needs exposes you to, on average, a 250,000 that you're going to need to pay for the average claim, but it can be multiples of that, particularly if you're unlucky enough to end up having a severe dementia disease like Alzheimer's.
Where do you see our political future going with long-term care with the new administration coming in?
So, well, I don't want to talk specifically about the new administration, but I
Okay.
think there is an increasing realization in the states, because I think they're seeing the significant rise in Medicaid costs that the states are paying because of long-term care costs as Americans age. And again, the oldest boomer in 2025 will be 79. So still before the peak claim year. So it's only going to get worse. So I think there are a number of states. Washington is probably the furthest along. They actually now do have it's called Washington Cares, which is a state funded, it's a mandatory system. So all employees in the state of Washington pay a payroll tax. It's 0.58% of their pay that goes into a long-term care fund. That's a pretty low tax rate, and they are entitled, after paying into the program for at least 10 years, for care from the Washington state plan, but the amount that's covered is limited to $37,000, which doesn't cover a lot. But at least Washington is there. A number of the other states are looking at that program. And there's a senior aging committee of the Senate, and there's a group in the House that are focused on a federal government supported long-term care system. Nothing has been implemented, but Tom Suozzi, who is a moderate Democrat from Long Island, has what it's labeled the WISH Act, which is a federal legislative proposal. It doesn't have a lot of sponsors yet, but that seeks, and that coverage, you, as an individual, you have to have, depending on your income, you pay the cost of care for a certain number of months or years. And then past that, the federal government under this act, if it passed, would step in and pay the amount over that. And I actually like that program. So it's Tom Swazi,
Okay.
Democrat from New York, if you want to talk to him. I like it because it does require individuals to put aside some money or buy a policy to cover some cost of care, but not necessarily enough to cover the very expensive diseases. So it's the Congressman Swazi's coverage is more a catastrophic coverage, but it would be that you as individuals or your family are responsible for some amount, either number of months or amount of claim payments that you would pay, and then there'd be this government program that would cover amounts above that as a catastrophic program. I don't see that being enacted at the federal level anytime soon, but I think there are more and more people in Congress who are focused on the need, same need that you're seeing, and then the states are experimenting themselves, with Washington being the furthest along. But I know California and several other states are looking at similar kinds of programs. I think ultimately, based on my 12 years of being at Genworth and CareScout and focusing on this industry, and probably being, as a company, we're probably the most knowledgeable. I think the best ultimate solution is a private-public partnership where you have to have either private insurance or private savings to cover some amount based on your income. So the lower income, the more the government steps in earlier, and then beyond a certain amount, particularly for the severe dementia type diseases, there'd be a government catastrophic cover paid by a broad-based payroll tax that would cover the higher level of claims beyond whatever the amount that needs to be covered privately. So I think that's ultimately what I think is the right solution. I do think it's very difficult politically because it's a long-term problem and Congress tends to have enough
They kick the
challenges,
can down the road
less
for
challenges
long
with.
enough, and then it goes to
That's right.
somebody else's,
And they've been doing that. They're getting to a point though with the oldest boomers being 79. So let's say in another year, so starting in 2026, there'll be probably 9 to 10,000 baby boomers turning 80 every day for the next 20 years. So I
Wow.
do think we're getting close because the oldest boomers are only a few years away now from their peak claim years. I think there being much more need to focus on how you're going to cover those 95% of boomers who don't have long-term care insurance. Some have put, some, maybe the top 20% have enough in savings, but the rest, I think it's going to be a significant challenge for them.
Tom, we're hitting the top of the hour. I really appreciate your time. I really enjoyed our
Yep.
conversation. I thank you very much. I think my readers are going to get a lot of value from this.
Well,
And
thank you. I thought it was a good interview. I enjoyed it. And again, going forward, if there are other Q&As you want to do to focus on specific aspects of your readers and their concerns, Amy and I would be happy to do that as well.